Good morning and welcome to the Pension Protection Fund live webinar to launch the 2017 Purple Book. My name is Megan Murray-Jones and I'm your host for today's session. Now today I have with me Andy McKinnon, Chief Financial Officer, and Hans Domber, Chief Risk Officer, both PPF. Welcome, gentlemen.
Good morning. Good morning.
Now Andy and Hans will be guiding us through the Purple Book launch, now in its 12th edition, and giving us the most comprehensive view of the defined benefit universe. In the first half of this programme, Andy and Hans will talk us through the key data findings and analysis of the numbers presented. Then afterwards we have time for Q&A. Now this is a live webinar, so we really do welcome your questions. So please submit any questions you do have in the box below, and we will do our best to answer all the questions that we can in the time that we do have. Now any questions that we don't have time for, we will follow up with you after the show. And we also are offering a hard copy of the Purple Book, as you can see here. So if you would like some light Christmas reading, then we will get in touch with your details. So Andy, I will start with you. Can you introduce the Purple Book, please, and tell us about it?
Okay, good morning. As you said, this is the 12th edition of the Purple Book. It is, I believe, online now for anyone who'd like to go and have a look. You described it as the most comprehensive picture of the risks faced by the defined benefit pension scheme universe. We compile this primarily from data from returns from the schemes themselves they've made to the pension regulator. That's a sample of, we think, 5,588 schemes, about 98.5% of a universe that we estimate to be 5,886. That's down from 5,671 the year before. I think I said those figures the wrong way around, I apologise. And over the last year, that's a reduction of around 800 schemes, or about 1 million people. So we are seeing a declining universe, reflecting schemes winding up, scheme mergers, and of course schemes entering the PPF assessment. There's a lot of data in here. We believe its quality to be very good. We analyse it extensively to help us understand the risks that we face in the role that we play in the pensions universe, and we hope that everyone logging on now or reading the book will find it similarly useful.
I'm sure they will. So if we can go on to scheme demographics, please.
Sure. The picture that we see is a continuing picture of schemes closing to new accrual. There's a relatively steady trend of schemes that have remained open, but what we're continuing to see is that schemes that remain open to new accrual are now also closing to new members, and we can see that trend continuing over the last year. A number of high-profile schemes have closed over the last few years, and some names from a couple of years ago are showing us close for the first time in this data. Schemes like Aviva, General Electric, a number of others. And it continues to be newsworthy that we hear, even now, British Steel scheme most recently, obviously, is quite a high-profile scheme, but we have M&S, Royal Mail, and even recent high-profile news about USS. As well as schemes closing specifically to accrual, we have seen a very significant trend in the decline in numbers of active members within there. So around 76% of members, of the 10.5 million members in the universe, are in schemes that continue to open to future accrual. So there are still significant members who are able to contribute, although only about 12% of members are continuing to do that. That's slightly down from 13% last year, again a declining trend. And within that, the proportion of active members does increase, so with scheme size. Seeing the much larger schemes, active members are about 14% of membership of schemes with over about 10,000 members, and in the lower end of the 8 to 12 in smaller members. But still 1.3 million members of schemes who are actively contributing. I made the point about concentration. There's a very high concentration of members in the larger schemes. So of the entire universe, 5,000 members are in the largest schemes. That's about 7% by number, but almost 75% of the total assets and liabilities. That 10.5 million members, that's down from 10.9 million in 2016. So whilst I have talked quite a bit about declining trends, it is still true to say that there are a lot of people who do depend on defined benefit savings as part of their retirement provision, and there is total liabilities of £1.7 trillion remaining in defined benefit schemes.
Great, that's really useful. And then if we go on to scheme funding, please.
Scheme funding has been recovering, but it does remain weak. Back in August 2016, scheme funding fell to an all-time low, has recovered a little bit since. When we look at liabilities as measured by the PPF compensation, which is how we tend to look at the universe, you can see that as at March 2017, there was the funding ratio was just over 90%, up from 85.8% at a similar point in time last year. So that's good news. Although if you were to look at the cost of buying out those liabilities in the marketplace with an insurance company, then those figures do fall, and we would estimate that on what we describe as a buyout basis, much lower figures of 67.7%, still up from 63.2% the previous year. The other thing that's been a feature of the year is declining interest rates. 15-year gilts fell by about 40 basis points over the year, although the equity markets rose at the same time. So those are both positive factors. Market movements by themselves that would have shown the net of those effects a small deterioration in funding, although when we overlay the effect of improving mortality, which we noticed last year, and we changed our assumptions about mortality, that increased funding levels by about 1.5%. So overall, the picture of the last year was a positive one.
It's good to hear.
Yeah. But the real I think most consistent trend over the last year has been the falling interest rates. Gilt yields have been on a downward trend really throughout the period of time we've been producing the book, over the last 10 years certainly, and that's a big problem for pension scheme deficits, which are obviously discounted liabilities. So whilst equity markets have more than doubled over that time, the gilt yield has fallen. Gilts reached all-time low in August 2016, and there's been considerable volatility over the last few years. A low point in 2012-13 with the euro area crisis. There was a sell-off in commodities in late 2015, and then of course the UK referendum result, followed by the Bank of England's further interest rate cut and the announcements of quantitative easing. And really, it's that volatility that I think is very difficult for pension schemes to manage. We have a chart which shows the liabilities over the last since March 16, when we first published the book, and you see a very, very steep increase in liabilities just after the UK Brexit vote, caused by that drop in gilt yields that I mentioned earlier. There was a record deficit in 2016 of more than 400 billion, which was almost double the deficit that you would have seen at the end of March 2015 or 2016. But by March 2017, the date of this book, funding has improved to some extent, and that has continued since as well. Over the year to September this year, gilts have risen by 55 basis points, and at the same time you'd seen index-linked gilts coming up, and also significant increases in asset values. FTSE All-Share, for example, rising by 8.4%. So through September and last month, when we most recently published the 7800 index, that was showing deficits had fallen to just under 150 billion. So a very positive picture, but having said that, some very high asset values, and interest rates again do continue to be volatile. We have put some sensitivities, you'll see in the purple book, which give you some sense of that, and our estimates are that a 0.1 percentage point decrease in gilt yields, we see a 0.7% increase in assets, but a 2% increase in liability. So that volatility does continue to be perhaps the biggest thing that pension schemes have to worry about from a funding perspective.
I can imagine. Thank you very much. So, Hans, I'll
Thank you.
move to you now. If you could talk us through the findings on asset allocation, please.
Yeah, thank you, Megan. The first one is sort of the broad asset allocation between equities and bonds and other investments. What we see with equities and bonds is a continuation of the trends that were already there. So in the case of equities, where maybe sort of 10 years ago it was around 60%, that has come down more than half to below 30% now. And likewise on the bond side, we've seen significant increases over that 10-11 year period from below 30% to close to 60% now. That's for the bonds. The other types of investment have less of a clear trend. It started off around 10% and it's now around 13%. It went up to 21 and then came down. And my next slide will give a bit more detail on that. If you dig a little bit further here, what we see is that the best funded schemes will have the greatest portion of their assets in bonds and less of their assets in equities. And likewise, as a scheme matures and its membership gets older, we also see that their allocation to bonds is increasing and equities is decreasing. If we break down the other investment category a bit further, and we got the data since 2009 when we started collecting this. What we've seen since 2009 is limited changes in the allocation to property and to all other alternative asset classes. A bit less in insurance, but the two main changes are around hedge funds on the one hand, which we've seen increase from around 1% in 2009 to around 7% in 2017, and a decrease in cash and deposits. Now the decrease in cash and deposits, it's always been sort of between 2 and 7% over that period. It dipped down to below 0% this year to minus 0.9%. We think that that's to do with the greater use of swaps and gilt repos, but there's also a bit of sort of improvement in the way the numbers are reported over the years. So it's not entirely clear what's behind that. If we dig down a bit further into the bond allocation, so we've seen first that itself went up from 30 to 60% or so. We started out in 2008 that all three bond categories, so that's gilts, it's inflation-linked and corporate bonds, they all started around sort of 1/3 each. And over that time we've seen especially the inflation-linked bond allocations seen that a steady increase of those. Corporate bonds over that period went up and down. It's more or less where it was before. Again, sort of around 30%, 1/3 of the allocation into corporate bonds. And the gilts, after some decreases, is now on a steady upward path. And we think that this shows a greater level of hedging, so more gilts to offset the risks in the on the liabilities, and especially also the inflation-linked bonds, which also offset the liabilities, which are also normally inflation-linked. On the equity side, very much a continuation of the trends that were there. We've seen a steady increase in the allocation to the rest of the world, so the non-UK equities, and a decrease in the allocation to the UK equities. It started out in 2008 more or less 50-50. It's now more like 70-20, with also a somewhat increased allocation of 10% to private unlisted equities. And if you think about that decrease of the allocation to UK equities coming from sort of 50% to 20%, if you looked at in the context where equity itself has come down significantly from 60 to 30, you can see that overall it's only about 6% of the UK defined benefit pension assets are invested in UK equities, and those two trends really are now at a point, I think, where the total allocation to the UK equities across the schemes is not that much.
Thank you. That's really informative. And then I think finally it'd be great to talk about risk reduction.
Yeah, so there's different ways to look at risk reductions. One is around special contributions, so these are deficit reduction contributions that scheme make over and above the normal contributions to their pension scheme. These are data coming from the ONS, the Office for National Statistics. And it's a bit of a volatile time series, but what we see here is that about 11.4 billion of special contributions were made into the schemes. That is less than it was last year, though, as I say, it is a volatile time series, and there was a big spike just before last year, before this year, which sort of skewed the numbers somewhat. There was a single scheme that made a contribution of more than 4 billion. So we think overall it is still significant contributions are being made, certainly if you compare that before the time when the regulator and the PPF were set up. Another way of looking at risk reduction is the recovery plan length. What we've seen in this particular tranche of data is that the deficit reduction plan length have come down somewhat. It's now 7.5 years. It has not been as low as this over the time that we've been looking at it. Now, this is all not totally comparable, because these are tranches, and tranche 10 is comparable to tranche 7 and it's comparable to tranche 4, because we are sort of on that 3-year cycle. So we can't quite say if this is a trend or not, but it's sort of encouraging to see that recovery plan length is now below 8 years, which has been sort of more or less constant before. A thing which is maybe slightly less positive is the technical provisions as a percentage of S179 liabilities. Now, that's a very technical measure. S179 is the way we measure the liabilities, is against the PPF level of compensation. And what we see there is that the technical provisions for this particular tranche is come down and is now below our own S179 compensation. That has got to do that, on the one hand, the universe is maturing, and S179 is maybe a bit more in line with what the schemes themselves have, but it could also be an indication that some of the assumptions that schemes are making for discounting their own liabilities are a bit more optimistic than before. A third way of looking at risk are the insolvencies. What we see there in the green line is a trend where sort of in 2010 we saw it peaking, the number of insolvencies, and it has come down since, and especially sort of in 2013-14 as the economy grew, we saw the number of insolvencies coming down. And it has actually stayed low at that low level. Now, this is of course the number of insolvencies. It doesn't say how large each of these insolvencies are, but it's a good trend. It has come down and it has stayed low over the recent past. And what that then means for ourselves is that our funding level has gone up and really has gone up steadily over the last 10 years. It's now above 120%. That reflects, on the one hand, the low number of insolvencies, but also, of course, it's our investment strategy. We've always put ourselves on the position that we wanted to hedge all the interest rate and the inflation risk on our liabilities. And as rates come down, that strategy has worked very well for us. On top of that, our investment returns have been good as well, beating our own internal benchmark for a number of years now. So we are in a relatively good position. If you compare that to the levels of deficits in the universe, you see that our PPF 7800 shows them around 90%. We are at 120%, which is of course a good thing, though that surplus that we have created is also there to protect us from any claims that may arise which are over and above the levy we charge. But overall we are confident to the future. We do a lot of modeling of this, and we feel we are on track to achieve our own funding objectives and make sure that we're there to pay our members and protect the wider defined benefit members as well in the future.
Thank you. That's a nice way to end the overview, and a lot of technical information there. So I'm sure there'll be a lot of questions. And actually, we've got a first question that's already come in. Deficits in the DB universe are still very high. Could the PPF handle an influx of large schemes should a number of businesses become insolvent? Whoever wants to answer that.
We do a lot of modelling, as you'd imagine, and this data is really at the core of that. We do a lot of modelling over a long time. We look at a range of economic scenarios, a range of credit scenarios, around 1 million data points in all that go into our model, and we project that forward, and that's how we come up with our probability of success, which has been consistently above 90%. And we are as confident as we can be that we are resilient to that whole range of scenarios. And of course, part of that modelling, we do assume that from time to time there are some large schemes, and from time to time there'll be highs and low volumes. But we plan to be around for a long time, and hope members of all the defined benefit schemes can take some confidence from that.
Well, that's good to hear.
Thank you.
Another question's come in. Do you think there is a chance that in 10 years' time there'll be no DB schemes open to active members?
That's an interesting question.
Yeah.
I think, sorry. It's an interesting question. As I mentioned earlier, at the beginning, there are a significant number of schemes that do continue open and do continue to take new members and accruals into those schemes. But really, I think the key thing is that in all of that, as I mentioned earlier, we are talking about 1.7 trillion of savings, and even when schemes are closed to future increments, there are currently 10.5 million members who are dependent on that as part of their retirement. So defined benefit pensions in the round are going to be around for a long time.
Yeah, we've sort of seen the trend of schemes closing to new members, that trend has stabilized. But of course, also in the press, you see every now and then stories about new scheme or about existing scheme considering if they wanted to close to new members. So I think it is probably still on a trend slowly towards closing, but I don't think that all will close in 10 years' time, as per the question.
Okay. We'll tackle this next one. Nice to get a challenging one in. There's been a lot of talk about people transferring out of DB schemes. Do you think this is sensible?
I think that a guaranteed income for however long an individual may live, whatever may happen to the market, and with inflation protection, is a very valuable thing. And I think for the majority of people, transferring away from that is probably not going to be the right thing to do. But I'd also say that for anyone who's thinking of doing anything like that, really taking good quality advice is paramount, because everyone's own individual circumstances are, of course, different.
Of course. Thank you. Another question we have here. Do you think deficits will reduce further if interest rates continue to rise? I know we mentioned interest rates before in the overview.
Well, what we see is quite a good correlation with the level of interest rates and the deficits. So if interest rates go lower, deficits tend to rise, and the other way around. And that shows to me that there's a lot of risk on the liabilities that hasn't been hedged yet. So there's open risk between the sensitivity of the interest rates for the liabilities and the one for the assets. So yes, if interest rates rise, I do expect the deficits to reduce as a result of that, unless, of course, that rise in interest rates also makes the equity markets and the asset markets go down. So there's a balance there. But on balance, yes, if interest rates rise, deficits will reduce.
Okay. Another question, coming in thick and fast. Special contributions to DB schemes have clearly fallen significantly compared with last year. Is this a cause for concern?
Yeah, we don't think it's a cause for concern. We still see it at a relatively high level at 11.4 billion. It is a volatile time series, so there are spikes in the time series. If big schemes make big one-off payments, we see these spikes, and that's also something which somewhere in the middle of 2016 we saw happening. That particular data point fell out of the sort of the four-quarter average, so you sort of see it coming down. We don't think it is a reason for concern, but of course we are vigilant to this and we are keeping track of that.
And of course, with recovery plans still at 8.5 years, I think we would encourage sponsors of schemes to do whatever they can to try and repair deficits.
Okay. I think maybe on the topic of concern, I knew Brexit would come in somewhere. What impact do you think Brexit will have on DB schemes?
Well, as I mentioned earlier, we use a lot of what we call stochastic modelling. So we model a range of economic and credit scenarios. The protection fund itself is resilient in the vast majority of those, and we're pretty confident that the pension regime in the round between ourselves with the regulator and DWP is, in the majority of cases, still working.
Yeah, and if people are interested in this, we publish each year in June, we publish our funding strategy update. And in this year's version, we also included some Brexit scenario stress tests in there. So there's some results in there if people are interested.
That's useful, and that's on your website?
Yes.
Mm-hmm.
Fantastic. Next question. What do you think is driving the improvement in scheme funding?
Well, that's I think a combination of the interest rates somewhat higher than they were at the lows that we've seen after the Brexit vote. It is the continuation of a good performance in all the assets markets. All equity markets around the world are generally up over the last year and years before that, and partly as well through the deficit reduction contributions which continue to be made. So those factors, I think, over the last year would have helped that improvement.
Yeah, I think that's right.
Good. And just another one here, I think, Hans, this actually touches on something that you mentioned. Why do you think investments in hedge funds are so high?
Well, I wouldn't say they're that high. They're increasing, but they came from a very low base. It was 1%, I believe, in 2009, and we're now sort of looking at 7%. I think it's an asset class which aims for absolute return, so it perhaps it's not as correlated with sort of the directional parts of like an equity investment or the bond investment. So I think it's scheme coming to the conclusion that it's an inherent part of their strategies to have an allocation to the hedge fund, and they think it's worthwhile that those investments help to sort of decorrelate, help to diversify their investment at an acceptable cost.
I think as well the graph makes it look quite dramatic, doesn't it? Whereas actually, as you rightly mentioned, it's useful to make sure that you understand everything that's going on behind the graph.
Yes, it is, and it's sort of a 5-6% increase, but that's over an 8-year time frame. So it is since 2009. So I would not see it as that dramatic an increase.
Okay, thank you. Another one's just come in. Do you have any assessment of what the PPF universe would look like in the case of a hard Brexit?
Wow.
I think I'd answer that the way I answered it before. I think we model a range of economic scenarios, and we've done some stress testing, which is a scenario. I think in the event of a hard Brexit, however that may manifest itself and whatever the outcome of that may be, is actually quite difficult to predict. So we look at a whole range of possible scenarios, and we look at how resilient that we believe our fund is to those, and I think that's as much as anyone can do, really.
I think since there's been a couple of questions on Brexit, where it would be useful to direct the viewers to where the stress tests are on your website, actually. So maybe we can send that to people after the show.
Yeah, people can go to our website. It's under the sort of the funding strategy update, which we publish each year. And I'm sure with a bit of searching, it's easily findable there.
I'm sure that can be people's homework for after the show. Unfortunately, that's all we have time for. So thank you so much for your time today, and thank you all for tuning in. Now, do remember that any questions that we haven't answered, we will follow up. And as I said, there is a hard copy of the PPF Purple Book if you would like it, so we'll be in touch for your details. But in the meantime, just to say that there will be an on-demand version of the show available by the end of today. So all I have left to say for is thank you from me, and thank you both to Andy and Hans for being here.
Thank you very much.
Take care. Thank you.